You're lying in bed, lights off, phone in your hand. Just one last check before you sleep. You open your investment app, and there it is. The number, $20,000, $50,000, $100,000. Whatever your number is, you finally hit it. You stare at it for a second, then a little longer, because for years that number felt impossible. You skipped nights out. You cooked instead of ordering. You transfer money into investments even when you really wanted to buy something stupid. And now, the chart finally curves upward. Compound interest is doing the thing everyone talks about. Your money is making money. And for a brief moment, you feel like you cracked the code. You think, okay, if it keeps growing like this, I might actually get rich. But something strange happens right after this milestone. Not in your bank account. In your life. Suddenly the world notices you're stable. Your bank offers a premium credit card. Your broker sends you exciting opportunities. Your car suddenly feels old. Your apartment feels small. You've been responsible for so long that your brain whispers something dangerous. You deserve to enjoy it now. And that's where the catch appears. Because compound interest is powerful, but it's also fragile. One small mistake, repeated consistently, can quietly cancel the entire effect. You won't notice it immediately. Your account won't collapse overnight. But 10 years later, the difference can be 6 figures. Compound interest sounds amazing until you make the one mistake most people make right after things start going well. And the uncomfortable truth? Almost everyone makes it. Not because they're irresponsible, but because the system around them is designed that way. Most people imagine compound interest like a finish line. You grind, you save, you invest, and eventually you cross a magical number where things start getting easier. And technically that part is true. The first $10,000 is brutal. The first $50,000 feels slow. But once you start compounding, the numbers grow faster than your effort. The problem is what happens psychologically at that moment. Think of compound interest like pushing a giant boulder uphill. The first part is exhausting. Every step feels pointless. But once the rock reaches the top, gravity helps you. Now imagine someone taps the rock sideways. Just a little. Not enough to send it rolling back down immediately, but enough to stop it from going straight. That tiny nudge, repeated over years, changes everything. That's what lifestyle creep does. That's what emotional spending does. That's what I deserve this purchases do. And it's incredibly common. According to a Federal Reserve survey, nearly 40% of Americans couldn't cover a $400 emergency without borrowing or selling something. Not because they're lazy, because the financial system is built around consumption. Advertisements don't celebrate savings. Apps don't reward patience. And banks absolutely love customers who slowly spend more over time. So, if you feel like managing money is harder than it should be, that's not just you. That's almost everyone right now. My name is Peter, and I'm weirdly obsessed with how money actually works. Not the motivational Instagram version. The real version. The one where small invisible forces quietly decide whether you end up financially comfortable or stuck working longer than you planned. Quick disclaimer before we go further. This video is for education and entertainment only. I'm not a financial advisor. I don't know your personal situation, and none of this is financial advice. If you're making serious financial decisions, talk to a qualified professional. All right, now let's talk about the moment where things quietly change. Phase 1 of building wealth is simple. Not easy, but simple. Spend less than you earn. Invest consistently. Ignore noise. That's the grind phase. This is where most people quit, because progress feels microscopic. You invest $500 and the market moves $40. It's like watching grass grow, but eventually something strange happens. Your money starts moving more than your contributions. You add $500, but your account grows $900. Now compound interest is alive, and that's when phase 2 begins. Not financially, emotionally. Your brain remembers every sacrifice you made. The skipped vacations, the cheap furniture, the old phone. So when you finally have breathing room, spending feels justified. You tell yourself, I've been disciplined for years, which is true, but the financial system sees something else. It sees a stable customer, someone with income, savings, credit history. In other words, someone banks and companies can safely sell things to. Suddenly you get better offers. Car loans, premium credit cards, travel rewards, investment opportunities. Notice something interesting here. The moment you become financially responsible, the system becomes much more interested in helping you spend. Not because it hates you, because that's how the incentives work. Banks make money from loans. Brokerages make money from activity. Luxury brands make money from aspiration. None of them benefit if you quietly buy index funds and ignore everything for 20 years, which is exactly what most long-term wealth requires. Boring behavior. And boring behavior doesn't generate revenue, so the pressure builds slowly. Lifestyle upgrades here. Convenience purchases there. A slightly nicer car. A slightly bigger apartment. None of these decisions are catastrophic individually, but compound interest works both ways. Your investments compound. Your lifestyle does too. Let's do some simple math. Imagine you invest $500 a month with a 7% average return. After 30 years, that becomes about $566,000. Now imagine something tiny changes. You start spending just $200 more each month. Maybe better restaurants. Maybe a car upgrade. Maybe subscriptions that quietly multiply. So instead of investing $500, you invest $300. That difference doesn't feel dramatic. It's just $200. But over 30 years, your final amount drops to around $340,000. That small monthly change quietly erased more than $200,000. That's compound interest. It's incredibly powerful, but also incredibly sensitive. Vanguard did a study showing something similar. The average investor underperforms the market by about 1 to 2% annually, not because they choose terrible investments, because they react emotionally. They chase trends. They panic sell. They tweak things constantly. And that small gap compounds into massive differences over decades. In other words, success often comes from doing less. Let me show you 2 quick stories. Alex and Jordan both reached $50,000 invested at age 30. Same income, same starting point. Alex feels proud. And honestly, he should. That's a real milestone. But slowly, life gets more comfortable. He upgrades apartments, gets a newer car, travels more. Nothing outrageous, just normal improvements. But his investment contributions slowly drop, not intentionally, just gradually. 10 years later, Alex still has investments, but the momentum never really accelerates. Compound interest never fully takes over. Jordan does something slightly different. When Jordan hits $50,000, he sets one simple rule. That number becomes the floor, not the finish line. He keeps investing at the same rate. And any raises go partly toward lifestyle, but partly toward investments. He doesn't become extreme. He still enjoys life, but the system stays intact. 20 years later, the difference between Alex and Jordan isn't small. It's massive because compound interest had uninterrupted time to work. And time is the one ingredient you can't replace. So what actually protects compound interest? Not complicated strategies, not secret investments. Just a few simple rules. Rule 1. Set a financial floor. Pick a number that never gets touched unless something truly serious happens. Emergency, job loss, real crisis. That number exists to protect your future self. Rule 2. Separate growth from lifestyle. When your income increases, decide ahead of time how much goes toward improving life and how much goes toward investments. If you don't decide deliberately, lifestyle will consume everything. Rule 3. Automate the boring stuff. Automatic investing removes emotion. No decisions. No hesitation. Just consistent progress. Rule 4. Be suspicious of financial sales pitches. If someone is aggressively selling an investment, a trading system, or an opportunity, ask a simple question. Who makes money if I do this? Often the answer isn't you. And Rule 5. Understand the real goal of money. It's not luxury. It's options. The ability to say no to bad jobs. The freedom to take time off. The flexibility to choose how you live. Those things come from stability, not constant upgrades. Because the real catch with compound interest isn't math. It's behavior. Protect your first milestone like it's the foundation of a building, not the celebration on the roof. Because the system quietly expects you to spend it. And the moment you resist that pressure, that's when compound interest finally gets dangerous. Dangerous in the best possible way. For your future.